Hey, hello, everyone. Thank you so much for joining the call today. We are very excited to begin part two of our four-part wealth building series. Please note that if you have not already watched part one, which is on the language of finance, you can do so by going to Apriem.com. Up on the top bar, there is a tab for education. And in the education tab, it will drop down and allow you to click on educational webinars. Once you get to that section, you'll be able to view any of our previous webinars. And of course, right on top, you'll see part one of this four-part series. So before we get started, just to cover a couple of housekeeping items, we have allotted an hour total for today, but about 40 minutes will be reserved for the presentation, and then at the end, we'll have about 20 minutes left over for Q&A. So with that, when we answer questions, which we will do at the end, you can submit your questions by using the question feature in your dashboard. And we encourage you to go ahead and submit questions throughout the course of the presentation, just as they come to mind, and then we'll circle back around to them in the end. Today's presentation is being recorded, and it will be available to rewatch on the website in the future at apriem.com. We would also like to encourage everybody to please stick around at the end and complete the survey. We do take your answers to the survey very seriously. We try to implement and change and update in an effort to continue to bring great content that is the way that you want it to be. With that, I'd like to go ahead and reintroduce our speakers for this four-part series. First off, my name is Josh Garland. I am our moderator. I'm also one of the financial advisors here at Apriem. I joined the team a little over 2 years ago, but I got my start in the industry back in 2009, and I have been a chartered financial consultant since 2013. I am joined by Christopher Whitaker and Megan Schwab. Christopher is our lead financial planner here at Apriem. He's both a certified financial planner and an accredited investment fiduciary. He obtained his bachelor's degree from Point Loma University in San Diego, California, and his advanced credentials from Boston Institute of Finance. Before coming to Apriem, Chris worked at a high net worth planning firm where he was trained in each of the financial planning domains. Chris is married with 2 small children who happily take up all of his free time. At his side, we have Megan Schwab, who is an associate financial planner here at Apriem Advisors. She graduated from Biola University in 2018 with a BS in accounting. Megan first got her start in the industry here as an intern at Apriem and officially joined the team in January of 2020. With that, I'm going to go ahead and turn it over to Christopher to get us started.
Thanks, Josh. All right, and thank you again, everyone, for attending. We're really excited to once again have many generations listening with us today. And before we get too deep into part 2 of our series, we wanted to revisit the real problem that we're trying to address with this series, and in general as a firm too. Wealth is typically not successfully passed on to future generations. Family wealth that lives on through multiple generations is actually a rare thing, and we aim to be a helpful tool so that our clients' families can be the exception to that rule. And so to reiterate some alarming statistics that you can see on the screen here, 90% of wealth is lost by the 3rd generation. 48% of Americans have less than $10,000 saved for retirement. Bankruptcy rates soar for lottery winners 3 to 5 years after they've won. And 27% of adults would need to borrow or sell something to pay for an unexpected expense of $400. So this wealth building series is really designed to speak to all ages and levels of wealth, and really starting from the ground up on how to approach wealth from both a psychological and mechanical perspective. And so today we're going to take the language and terms that we explored last time and then put them into practice as we walk through the stages of life, building and compounding financial wealth. And so before we get too deep into this content, I just want to kind of set the stage a little bit. I'm going to pass off to Megan here in a second. So what we're going to do today is we're going to follow a couple throughout their life and take a look at what building wealth over time using the principles that we've discussed can actually look like. And so with that being said, I'm going to have Megan introduce us to Adam and Allison Affluent.
Thank you, Chris. Yes, so we're going to go ahead and introduce you to Adam and Allison and take you through their wealth building story. By doing this, we're answering the questions, what would happen if someone followed the wealth building series and other education they learned along the way and had a healthy relationship with money starting in their teenage years? So before we begin the story, there are a few key facts we want you to keep in mind as we tell it. The first stage starts at Adam and Allison's age 18, and they're not inheriting any wealth from their families now or even later on into their life. Everything we're showing here is based on what they've earned and what they've done with their money, so there's no inheritance in play in this scenario. Second, both will start their careers at entry-level jobs. We made sure that for this purpose, they aren't starting out in a job situation that gives them a higher than average starting salary. So we're showing someone who starts from a humble beginning, making a very average entry-level job salary. In that same vein, neither will make more than $100,000 a year in today's dollars, even during their peak earning years. You will see later on, but this is to illustrate the power of saving, compound interest, and the importance of having a technical and philosophical understanding of money. Third, they will be able to comfortably retire without the help of a traditional pension or Social Security. While it's a positive thing to have a pension or Social Security as an option, we wanted to illustrate that it is possible to not have to rely on these things in the future and truly be financially independent. These things can merely be seen as an extra or a bonus on top of what you already have. And last but not least, they'll end up with wealth that'll last through many generations. This is something Chris will elaborate on near the end of our story.
I'd like to just say that what I really like about what you guys have laid out here, and I've had the advantage of hearing the story before, but I like that this is really representative of the majority of America. You know, if you create a profile where, you know, there's tons of income coming in, right, and we're off to a great start, and we get an inheritance down the road, right, those kinds of things are much easier to paint a pretty picture with, right? But I think that this is much more representative to the everyday person. And regardless of the fact that we'll track this based on ages, you could find yourself in any of these stages at any age, and you can still apply the principles to your life. So I really like what you guys have done here. Excited to continue to walk through it.
Absolutely.
Mm-hmm. Well, with that, we're going to go ahead and get into stage one of Adam and Allison's story. So this stage, we're really highlighting those late teenage years and college years. So Allison and Adam have started with that philosophical and technical education with money. These are fancy words, but really they just understand not to spend more than they earn, not to take on too much debt, and they're starting to understand what compound interest is and the value of that. So as you look at this and we go through the story, we're looking at this to the point of view of them having gone through Apriem's wealth building series and developing that strong understanding. And as you can see on the balance sheet, neither of them have very much money at this point. They've saved portions of gifts they've received from family over the years and money from odd jobs. Maybe they put $10 to $15 into either of their accounts here or there. But again, they don't have a lot, but they're just working with what they have and using the education that they have to start funding those accounts. Their main focus at this stage is to work towards their education and prepare themselves for the working world. In other words, they're preparing to successfully trade in their time for money so that one day they won't have to do that anymore.
I would note, one thing on here is the fact that they each have some form of retirement account for long-term growth, mm-hmm. and they each have a brokerage account for maybe shorter-term expenses that they might want to focus on, without necessarily just looking at using a savings account to accumulate. Right, it's somewhere we can actually invest the dollars.
Mm-hmm. Mm-hmm. Yeah, absolutely. Yeah, you're going to see us consistently bring things from that part one into here, and we talked briefly about kinds of accounts. There's two kinds that have been introduced so far in Adam and Allison's story, which is a brokerage account and Roth, to your point, Josh.
Mm-hmm. Mm-hmm. Definitely. So now we're entering stage two. They've graduated college, and they ironically went through the same wealth building series, the same high school. They were high school sweethearts, and they went to college together, and now they're married.
How convenient.
So perfect.
Worked out well.
Definitely. So now their biggest focus is paying off their student loan debt, really building up their savings, and being mindful of their expenses. And while being mindful of expenses is important at all stages, it's very pivotal at this stage as they have a lot of big expenses they would like to do in the next few years. So if we take a look at their balance sheet, they've saved up a bit more in their brokerage and Roth IRA accounts, and now that they have jobs, they opened up 401ks with their companies. So that both their companies happen to offer a matching program, so they're taking advantage of that through saving into those 401ks. Another interesting thing to note here is their net worth is negative due to the student loans, but they're working very hard to pay those off, and they're actually in this situation paying the double the minimum required every month. So they're really trying to chip away at those and get those paid off fast. And one other thing, it's very common to have a negative net worth at this stage. Because Adam and Allison are saving well, keeping track of their expenses, and paying down their debt, their net worth should be back to the positive in no time.
I just want to put one thing out real quick before we keep going through this, is that I think it's normal too to feel almost discouraged at this point, because you have this negative balance sheet, and yeah, like you're following all these rules and you're supposed to be doing everything right, and you're not seeing your net worth really explode yet. You're just seeing small amounts of dollars. I mean, even a 10% return on a $1,000 account doesn't really feel like much. But it's important at this stage, if you're listening to this and you're in this stage, you really just need to keep pushing through. And as we go through this story, I hope it's kind of encouraging too, because it's easy to be discouraged, but if you keep sticking with it, keep that compounding snowball going. Every dollar matters, and we're gonna see that play out here.
I think that if anything, as we continue to look at this is a story of developing habits, good, healthy habits.
Mm-hmm. Absolutely.
Mm-hmm, definitely. And here we kind of get a background on what those habits look like for them at this stage. So you can see under their salaries, they're both, making a very average salary, $45,000 a year. If you go down a little bit further, you can see that they're putting a little over a quarter of that income into their savings. So like Chris said, every dollar counts, and they're trying to maximize the time they have to start saving, whether it's for a home, for retirement, or any other, expenses that may come their way. They're working really hard to make sure that they're ready for those things. Mm-hmm. Something else that's included in that planned savings, as I mentioned before, is their 401k contributions. So right now they're putting 10% into their 401k so that their employer is able to match a percentage of that. And they're really setting themselves up well for retirement by prioritizing that and taking advantage of the opportunities they have there. And if you can see on the pie chart on the right-hand side, some of their income is being allocated toward their Roth IRA to prepare for their future as well. But again, they're really focusing on their 401ks at this point in time. And before I pass it off to Chris, there's one last important note that Adam and Allison are taking into consideration when they're trying to balance their finances, is that although they're saving a lot and paying down their debt, they're also allowing themselves to responsibly spend their money on fun things. So while they're being responsible, they're still allowing themselves to have fun with the money they've earned, and not just, save.
Oh, so this can be fun. Oh, okay. Good.
That's the goal.
Yeah. And then just another quick thing on the snapshot here too, if we go back, sorry, making one slide. So we talked about from series 1, again, just bringing that concept forward of diversifying the balance sheet on your net worth, right? And so if you see here too, again, their savings percentage is based on what they're saving, right? So roughly 40% of what they're saving is going to a brokerage account too. So they are building up purposefully a non-retirement asset. So they've got pre-tax from the 401k perspective. They've got an after-tax special account in the Roth category. And they've got some normal cash, and then obviously the joint brokerage account that's going to be used to fund short-term goals. like maybe trying to buy property, et cetera, things we're going to be looking at. So again, you're starting to see the balance sheet morph a little bit here as we bring some of those concepts forward. All right, let's go to the next stage here. And I think what Josh said too is really important. Again, we're just reiterating that these stages are going to blend together. So not to get too hung up on a certain age per se. It's perfectly normal to be tracking ahead or behind any of these stages. Adam and Allison kind of had the benefit of starting off in their teenage years with the right foundation. That's not everyone's case. So stage 3 is kind of, typically it's late 20s, early 30s type of range. Just starting out planning for a family. Maybe you have a child already and you're trying to purchase your first property. And when you can kind of see here, let's go ahead and head into the balance sheet, is, we have added another asset class. So we've added real estate. And I want to point out that it wasn't like it was their dream home right off the bat, right? So if you're in this stage, what they knew already though from previous teachings was that getting into the game was crucial here. So they want to take part in that asset price inflation effect and storing up their saved time in the form of money and assets. And so they got into the game in real estate, right? And they were very mindful of what their mortgages, keeping it at a reasonable level. And you're going to see, expenses are mounting, but they keep their savings automatic. So you can kind of see the balance sheet again starting to morph a little bit. We've added yet another kind of leg to that retirement stool underneath it, keeping it stable. And what we have taken on a lot more debt now too. But it's debt that's kind of building wealth at the same time. So it's and let's go ahead and hit the cash flow statement. And then on the cash flow side, you can see here, they have increased their salary a little bit. So I think it's important to note that in these first few stages here, when you're in this stage, it's also really important to increase your own value to increase your salary. It's hard to understate that, investing in yourself and creating more value to drive that income and drive that top line for yourself. And you can see they have some taxable investments, retirement accounts, they're keeping that diversified. See the salary at $65K a piece at this point. And you see their cash outflows. They still have their planned savings right off the top. That's important. They're keeping that together, even though their expenses are rising. Now that they have Adam Jr., so they have one kid right now, and you're still seeing that their portfolio is really starting to grow into something meaningful at this point because they've kept up with that savings.
I think an interesting thing to note here too is if you're looking at the second year in that picture, and we're looking at liabilities, you're seeing the increased expense from purchasing the home, right? So down at the bottom, yes, our net cash flow has decreased. The previous year we had $27,000 in net cash flow after expenses. Now all of a sudden we're down to $3,500 of net cash flow at the end. However, that $24,000 that we're paying into those liabilities on the home is also building equity at the same time. So it's building into that long-term net worth.
Yeah, absolutely. And I realized too, I missed one on the previous balance sheet. There was a little line item there that said UTMA. So they did start a UTMA account as well for Adam Jr. And they don't have a lot of cash flow to put money in themselves, but they have it there maybe for family and friends to give gifts or maybe a little bit of money over time, just something to get started for Adam's future too. So we're already starting to work a little bit on that next generation too in this stage. And so let's go ahead and go to stage 4. All right. And so for stage 4, right, so this is typically maybe late 30s, early 40s. There are multiple kids in this stage. Expenses are really rising rapidly. This one hits home for me. I've got 2 kids now, starting to creep up there, trying to work on education expenses. But we are going to also bring in, again, concepts from the previous lesson so here Allison's actually going to start her own business. And so now we're going to start to see a little bit of both types of worlds, right? And so when we're building this in here, not to show you that you really, actually to show you that you don't have to purely have a corporate job or pure entrepreneurship to build great wealth. I think we get that a lot, or at least I get that question a lot from younger people is, all the rich people are the ones who start businesses. Well, that's not necessarily true. It's more about money habits over time. Great book, by the way, is E-Myth on that. It's kind of a tangent. It's a great book.
Fantastic book.
Yeah. So, and then we're going to have Adam kind of build the more traditional wealth side, whereas Allison's going to branch out. So Adam's going to stay on the corporate side, kind of work as an employee for his career, and then Allison's going to switch to a more entrepreneurial endeavor. But she's not going to gross more than she was. So we're not going to have Allison strike it rich. She's just going to replace her income from an entrepreneurial perspective. And let's go ahead and go into the balance sheet here.
But she's happier because she's working for herself.
I don't know. I'm pretty happy. It's a shameless plug. I think my bosses are listening to this. And so, and then on this, where you can start to see is we are adding that another asset class here. Right? So we're adding some private business here, right? Not just stocks. Now we've got a brokerage account. We've got 401k. Allison no longer, we're just going to keep it real simple for her. We're not going to do anything complex here. We're just having to roll it over and contribute to an IRA now. We're not going to do anything fancy there. And we still have the Roths that are going. We have Allison's marketing agency, and then we have the primary home. Now, one thing here too to note is that you'll notice that the home has increased. Not only is it, what we've done is we've actually taken the equity from the previous one, and we've used getting in the game there, selling that net equity and using that as a part of the down payment for a bigger property now that they've got multiple kids. So now they're in more of a long-term home, but with a bigger mortgage and more expenses as well. We also have UTMAs going for all 3 kids. So again, we're continuing with that next generation, getting them on a firm foundation, just kind of contributing small amounts over time, and also a place to capture gifts for all 3 kids. Got Adam, Amanda, and Ashley. They love A's in this family, apparently. And you can see their net worth continuing to compound as well. And so let's go ahead and go to the cash flow statement. And the cash flow, a couple of things here I want to point out. Obviously, so you're seeing, again, that nice balance of taxable and retirement. Again, not necessary, but we're just started from that perspective. You see their inflows. We promised we were going to cap them at 100K each, so they cannot go over that amount. And then you also see living expenses have dramatically increased on the previous, whether it be from taxes, liabilities, expenses, etc. And so planned savings is actually a smaller dollar amount than the previous stage. So we're being squeezed a little bit here on the expenses. So very normal if you're in this stage of life listening here to have that kind of squeeze on your cash flow. But it's important to note that they are doing that no matter what, they're at least saving roughly 10% or so in this case, going for the long term into the future. And so you're kind of seeing that continue to play out. And they're just letting that compounding math continue to play out. They're constantly keeping in their mind the investor definitions for all the things we've talked about. And that kind of carries them through to stage 5.
Okay, and moving into stage 5, the affluents are kind of at that pre-retirement age, around their mid-50s, and they've really been building up a comfortable amount of wealth. And as you'll see, their portfolio is built up and more diversified as they're getting ready to enter into retirement.
So I think as we jump in here, I like to point out that, pre-retirement age, 10 to 15 years away from that, where, we're going to stop working, we're going to retire, that is a prime time to really start working on and tooling some type of a income distribution plan for when you get there. You start planning ahead of time, you give yourself time to reposition assets and get, and reposition from an accumulation stage of your life to a distribution stage of your life. I'll go and pass it back over there, but I thought, it's a great kind of point, as you start thinking these things, what should we be thinking about when we get to these different stages?
Definitely, and it certainly gives you peace of mind knowing that you will be ready at the time you want to retire.
Absolutely.
Yeah. So looking at their balance sheet, Allison's marketing business is still doing very well. Like Chris said in the last stage, it's staying steady. So we're not modeling her, hitting gold with this business, but it's certainly successful, and she's maintaining it well. As you can see, their investments have grown significantly. They're continuing to keep their debts low. Their mortgage is so close to being paid off. And you'll notice that you don't see any UTMA accounts listed here anymore. So their kids are grown, and now they have ownership of those accounts. So you no longer see that here. So this is just a result of the compound interest and their continued saving. And as we go into the cash flow statements, we're actually going to be introduced to another investment which is the stock options line you'll see about halfway down. So Adam's employer has given him another form of compensation called an RSU, or restricted stock unit. So he's receiving a certain amount of stock, in this case 10 shares, from his company every year for 10 years. And by the end of those 10 years, he will have 100 shares of their fully vested stock. That also means that that stock is now completely under his ownership. So in the first column of this cash flow statement, we're seeing that those first 10 shares come through for him. And again, their living expenses have increased a little bit with inflation. Their savings, again, it's lower than it was in the earlier stages, but they're still maintaining their savings really through their Adam's 401k, as well as Allison's IRA and the brokerage accounts. And now on to stage 6.
Okay, stage 6. Now, some of you listening are already in this stage, so kudos to you who've already made it. You've already made it, and some of you listening, right? So you no longer have to trade in your time for money, and you already get to live off of the money you've saved and let your engine just kind of keep trucking along for you. And so, we're going to introduce the concept of maybe adding a couple more asset classes to the balance sheet, diversifying that part of their estate, and then also showing kind of where income's coming off of from their wealth engine that they've spent these last few decades building up. So let's go ahead and take a look at their balance sheet. And so the first thing here, obviously, you can see taxable investments. Now, the qualified side has overtaken the taxable side, which is very normal. It's not always the case there, but it's normal to see there because it's been growing tax deferred this whole time. So got a couple different piles of money there. Again, Adam does have some stock options, but then Allison's got her marketing agency, a little bit of value stored there in the form of maybe retained earnings and things that we can discuss more. But then we've also added some common things. So oftentimes, a plan might have some rental property. So Adam and Allison happen to have purchased a duplex at a point throughout their wealth accumulation phase. So they have a duplex here that provides some rental income, also some tax efficiency there in the form of depreciation and things that we'll get into later in the series. They still have their primary home. Now you'll notice on the primary home side, the mortgage is actually a little bit higher than the previous section. We decided to mimic kind of what we're experiencing right now, very normal to do some kind of a refinancing scenario, take advantage of very low rates. The mortgage is actually a little bit higher. Also important to note too that, sometimes I think it's a misnomer that you have to have no debt going into retirement. There's times to have some debt if you want to play some arbitrage there. But we have a comfortable amount of debt for for Adam and Allison as they're going into retirement relative to their net worth. And then we also added some private equity. This can take a lot of different forms. We're being very broad here by saying private equity. It could be, different kinds of real estate, startups, that kind of thing. It's more of a high upside. They have the net worth to take the risk, and so they're going to add that to their balance sheet as well. And let's go ahead and go to their cash flow. And so the cash flow side of retirement, obviously, it starts to get pretty complex, but we're going to keep it more high level for today's purposes. So we've got taxable investments, retirement accounts. So from the taxable side, you've got dividends, capital appreciation from stocks coming in. You can sell those without having to worry about income consequences and things like that. Retirement accounts, same thing. Maybe you've got some fixed income from interest coming off the bonds. When you pull from that account, generally it's going to be taxable though, right? So you have a little bit of a mix there to kind of smooth out your tax rate over time. We've got some stock options and grants as well up there for the portfolio asset side. And then you'll also notice, of course, that the cash flow. Now, again, we have Social Security in here. We don't need it, though, is the nice thing here. So it's just gravy for Adam and Allison because they planned ahead, but they do have it coming in. And then we have the net investment from the duplex income coming in that's going to last. And then, of course, we have business and trust income coming in as well. So you can see here, even though their living expenses have dramatically increased over time throughout their wealth, the wealth building stage here, and liabilities are still high with obviously higher taxes, et cetera, there's plenty of cash flow to cover those kinds of things. And even, again, it's normal too. We built this on purpose to be this way, where there's a little bit of negative net cash flow on an estate. But this is just the cash flow portion, whereas they have this nest egg that's been built up that is also appreciating to more than cover that net cash flow burn.
So essentially what you're saying is all the additional money that they have saved over time is available to pool from to cover that $20,000 shortfall we're seeing there at the bottom.
Yep, absolutely. Yep. And so by having all this diversification, they've built up this nice balanced, I've used this analogy and I probably overuse it, but it's this stool analogy, right? Where retirement can be seen as this stool, where each leg underneath the stool makes it sturdier. And so they've really built up all these different assets over time. And then last, but certainly not least, we wanted to touch on legacy. And so legacy, we put this at the end, but it certainly isn't just applicable to those who are already rich or already later on in life, of course. This is the section where you're kind of asking yourself, what's it all for? And what do I want to be remembered by from a financial perspective? And we chose a couple of common goals here, but obviously there's an almost infinite number of goals that you could place here. So we're just going to walk through some of Adam and Allison's hypothetical choices here. And so what they chose was, the first one is each subsequent generation has a firm grasp of money and are good stewards of capital, right? So it kind of brings us all the way back to that first stage of setting a really good foundation and not having money ruin somebody, but I think it's said, I forget the exact quote, but it's something along the lines of what money does is it actually amplifies who we are. And so money passing on when they're not ready can actually ruin somebody, whereas if they're good stewards of capital, it can be a very beneficial blessing. And so that's that first section there. And then they also said they wanted a mix of assets left to charity and directly to children. Again, very common mix of charity. You want to still take care of your family. But these two can also mix too, just kind of throwing some ideas out here. Oftentimes, charities or charitable entities can be run by the children as they go throughout life, as that money gets passed on, which is nice to see. And then this last one here, it's not for everybody, obviously, it depends on the financial situation, but I will say there are some really powerful conversations that I have seen take place between families when different family generations kind of come together in a room and kind of talk through, both from the person that the generation that has the wealth, but then maybe that second or even third generation being a part of the conversation, where kind of let it known that their kids are want them to work together on a portion of the inheritance. So they have some individual pieces, but then also working together. And it's amazing what families can accomplish when they come together as cohesive units, talking about legacy.
And so these are decisions that in conversations that are had prior to mom and dad passing.
Mm-hmm. Absolutely, yeah. I think those are some of the most powerful ones that I see from my perspective that we see as advisors, is when families try and get on the same page.
Absolutely. I mean, why not get them in, and get them educated with, what are we doing and how are we managing these assets that eventually are going to be yours anyway.
Yeah, absolutely. Yeah. Yeah. And so, with that being said, we're coming right up on the time limit for the presentation part here. But hopefully that was kind of a fun exercise for everyone to walk through on what it can actually be like from a mechanical perspective as we kind of take these step by step. And I think we're going to enter into some Q&A here.
All right, it's question time. Hello, everyone.
Hi.
Thank you for joining us. Okay, so let's see here. First question that I can see here. This is a good one. So ideal percentages for various categories of spending and saving.
Ooh.
Are there some, I guess, especially in those early stages, what are some of the ideal percentages that you would be, you would structure for somebody?
Yeah, so I think obviously people could be listening from different states on this call, so some of this can be more idealistic, but I'll approach it from that accumulation phase first. So I think if you were to, let's just start with 100% pie chart and break it down from the top. So first of all, I got to pay Uncle Sam. Let's just assume 25% taxes. So you got 75% left over. I think it's always important to automate the savings portion of that. So let's go 20% at a minimum into savings. All right, so that's about 55% left. 20% would be ideal kind of home cost, in my opinion, off of that gross number. So 20% on mortgage, P&I, property taxes, et cetera. It's a very, very comfortable budget as far as home goes. And 5% of that could be spent on transportation, car payments, that kind of thing. And then that leaves 30% left over. And that 30%, I think this is where the wiggle room comes in, kind of everything else, kind of a broad category. I think especially when you're first starting out, you might have to pull some from that 30% into the previous categories, especially on the home side, maybe when you're first starting out. But those are some nice things to shoot for sure. And if you can beat some of those numbers, then fantastic. Kudos to you.
That's fantastic. That's good platform to run on. Nice rules of thumb there. Okay, this is a fun one, and I guess we didn't really address it when we were talking. But what is a UTMA account or an UTMA?
So UTMA is a Uniform Transfer to Minors Act, or a Uniform Gift to Minors Act. But these are basically custodial accounts that are used to protect assets for minors. Typically, the usual stocks, bonds, ETFs, mutual funds, cash are in these accounts. And these are protected for minors until they reach the age of majority. Mm-hmm. So depending on the state, it could be age 18, 21, or even 25 in some situations. And one of the benefits of these accounts are actually tax benefits. So for children who are under 19 and file under their parents' taxes, there's a certain amount untaxed in the account, while an equal amount is taxed at the child's tax rate. So I think this year it's $1,100 is tax-free, and then that same $1,100 or the next $1,100 is taxed at the child's rate for 2020. But once that child reaches the age of majority, that becomes their money and they can use it at their disposal. And one of the most common uses for these accounts is for education costs. Mm-hmm. So the custodian of the account, which is typically the parent, will take the money saved in that account and use it for college or whatever expense is necessary for the child.
I think we use the UTMA too because it's a little more flexible.
Yeah.
Mm-hmm. It doesn't have to be used for education. It can be used for lots of different things. It's just got to benefit the child directly. So there's some strict rules around it, but then it's also more flexible in some ways. And I think the reality of the situation too is that there's a lot of different kinds of accounts for minors or children. And it kind of depends on really personal plan on which one's best for you, because there's so many different pros and cons across the board for various accounts like that.
Yeah, I like the UTMA accounts. I mean, I think I set one up for each of my kids, and I think the thing that I like about it is the flexibility. Let's be honest. If I do a 529 account that will get better tax treatment as long as it's used for education, that's fantastic, right? However, I'm very confident that one of the two of my kids is going to college, and the other one I know I'm going to be fighting with. I'm going to say them. I'm not even going to identify which one of the two it is, but I know one of them I'm going to have more trouble getting to go to college, and I know the other one is just going to ride on board. Yes, Dad, but is all about it. And so the fact is, I can start saving money aside in an account like this, and it doesn't have to go to education expenses. It could be used for something else, like the purchase of a first home. I don't know, maybe paying for a wedding, whatever it may be. The other thing that I really like about it actually is that the ability to buy individual stocks inside of the UTMA account. So for my daughter, she loves Disney. We buy Disney stock every time enough money accumulates to buy a share. We buy another share of Disney stock there, and we talk about it. And then for my son, he's all into video games. So we invest. There's a video game ETF that we buy for him. But the idea is really, it's not so much about what you buy. There's so much time, that these accounts can grow and accumulate over time. But it's about getting them interested. Right now, it's something that they can have conversations about, and they can see the dollar value grow. And Grandma and Grandpa can, they can put money in there on birthdays or at Christmas time. I just think it's a fantastic tool for saving for kids and getting them interested. Okay, next one. Yeah. All right. So let's see here. The next one on the list I can see here. I have one that says you mentioned legacy. Oh, should everyone have a trust or just somebody who's in those end stages?
Okay, yeah. So I think I briefly touched on this, but I think the answer is it's appropriate for lots of different levels of wealth and stages of life. And so really the way I like to, I'm being kind of oversimplistic here, but in my opinion, it's more about having your wishes for what you have kind of be passed on and followed for that next generation. So, like for example, even when I had no wealth, really any true wealth, I still had a trust in place for guardianship provisions. When I first, when Colt, my son, was born, things like that. So there's lots of other things that it can be used for. It's not just for wealthy. And I think it's never too early to think about what you want your legacy to look like. And working backwards, I think, is also incredibly helpful for lots of things, but especially in finance. When you work backwards from an end goal, I think it's really incredibly powerful to plan that way for lots of different facets of finance.
Here's another one. In this example, Allison has a marketing firm worth about $100,000. How would someone who owns a business turn that private asset into cash or cash flow?
Can you say that again?
So in the example, Allison has this marketing firm's worth $100,000, right? So how would somebody turn that business into a private asset, turn that private asset into cash or cash flow, like a cash flow type of asset?
Oh, like throughout the rest of the, I'm assuming the question is kind of more towards like letting it extend for a long period of time?
I would assume that, my guess is it's probably referring towards when we get to returement, and it's listed on there, right? And at some point we stop working, but if we still have ownership in that business, how does that turn into something that generates cash flow? By the way, if I'm getting your question wrong, please feel free to clarify in the question box there.
Yeah, I think it really, so the type of business matters in this situation. So I guess if we're specifically talking about the marketing side, it's more of a services-based business. So there could be some value to be sold from a clientele perspective. If there's something tying those clients to the business, there could be some value there. Typically, it's multiples of revenue or EBITDA, depending on how you slice and dice that. So there's literally sales value that you could sell for a lump sum and then turn around and invest that for cash flow. Or oftentimes businesses can be passed down to some kind of successor situation where maybe you can still collect some income off of it, but it's still being run. You're kind of in the background, not spending as much active time on it. There's a lot of different ways that can kind of unfold, and I would encourage whoever asked that question, please seek us out. Let's have an individual one-on-one conversation for that.
Yeah. Did you mention like installment sale?
Look at that too.
Yeah. So another common way that business owners will turn their business into cash flow is they'll pass it down to let's say we don't have a child that joined the business, right? But we have that leading officer, that right-hand man, and we go, you know what? I really want the business to go to this person as I decide to ride off into the sunset, but I know they don't have the money to just pay me outright right now. You can set up a situation where it's an installment sale where they slowly but surely over time buy you out of the business. And that can allow for a slow transition till eventually you're no longer working in the business at all, but you're still collecting income as an income stream over an extended period of time.
You spread out taxes too, which is nice.
Mm-hmm. Yep, absolutely. I'm going to backtrack a little bit just because I think it's a good question to ask. Can grandparents be custodians to the UTMA? If so, who gets taxed?
Grantor is going to be taxed. So, you have to be really careful with this though, because under current law, and by the time you're watching this video, maybe it's changed, so just currently, it falls under a trust category, which rapidly increases in tax rate as income is accrued. So it may or may not be appropriate, especially, I'm just assuming grandparent has more wealth than that next generation. There's pros and cons there, but it's possible.
Okay, let's see here. Oh, okay. This is actually a great question because I think this can go in a couple different directions here. Good topic. So in the income statement models, what rate of inflation did you estimate?
Ooh.
Any ideas of what it should be for a normal inflation, especially medical cost inflation for the next decade?
Okay, so without giving too much of a crystal ball here, I'm just going to, from a conceptual standpoint, answer first. And so it's a really important question because I think anyone who's done a financial planning session with me or the team here, I've said this phrase to you a million times. What matters a lot is the purchasing power of your dollars throughout retirement, right? And so what inflation rate you're assigning to your expenses, you're just looking for your growth to be above that to keep up or exceed that inflation rate, right? And so there's a lot of different kinds of inflation. So your question kind of already alludes to that, right? So the rate of inflation on healthcare may be very different than technology, which is deflationary in nature, right? There's all these different varying expenses that will expand or over time at various rates. And so, I think it's appropriate to be very conservative in plans. That's how we operate here. So for basic living expenses like CPI, we're using a couple percentage points ahead of the average on purpose, compounding every single year. For healthcare, if you read, you can get varying statistics. Some say 4, some say 5, some say 7% or higher. I would just take the high average of that. And that way you can always feel good about your plan, knowing that you're starting from that really conservative base. And so I think, that's, yeah, I don't want to give crystal ball conversations, so we can talk more one-on-one if you'd like about what we think inflation's going.
Yeah, I mean, I think the best suggestion you have there is that if you're looking at it using something that's over what the Fed's targeting is going to be the way to go, right? We want to look at 3% or more and understand that, hey, we're just giving ourselves some cushion, in the case that that inflation does spike up a little bit over time.
Mm-hmm.
Let's see here. What else do we have? Did I miss any others in here? I don't know that we have an answer to this. If not, we can reach back out and answer this question directly. But the question is, Chris, I don't know if you know, or Megan, if you know, because I know I don't. For 2020, what is the typical length of time it takes for an individual to pay off college debt?
Ooh. No, I don't know the figure off the top of my head. I think that's a really, really big range. Yeah. I mean, plenty of friends that are on the back end of that it took them the entire decade plus. Maybe they're still paying it off. Other people with less, right? So I think it's too individual to say some big blanket statement.
They have different ways of structuring it. There's income-based or just the flat rate you pay every month for 10 years. Point. So it just depends on your situation and what you want to make of it and how much debt you actually do have.
Yeah, I wish we could be more concise for you, but I don't know if there's a.
Yeah, I'm sure. I'm sure depending upon when you come out and what career you get and how much income you have coming in and how much you choose to to carve out of your income to pay it off and how fast it would go. But we'll see if we can look something up, and if we find any statistics for you, we'll reach out to you directly and send you an answer to that. Let's see here. So the question is, can you go over the 30% wiggle room?
Oh, sure. Yeah, so again, I just want to be real clear here. I'm speaking kind of in broad terms for a second. So I think the original question was something along the lines of ideal percentages, a breakdown of your salary, like where every category goes.
That's right.
And so I'm just kind of speaking from a CFP textbook standpoint. And so a textbook would say an ideal scenario, again, is right off the bat, you pay Uncle Sam, so maybe 25% in taxes, another 20% in savings, 5% of that gross number into transportation and things like that, 20% into home costs, and then 30% covers just kind of miscellaneous, right? So I think your question is really hammering on or wanting to get deeper on that point. And so it can be, where I was saying pull from, right? So let's just put yourself in, let's say you're in your mid-20s and you're trying to buy a condo in Southern California, and a condo costs $600,000, whatever the number is. It's going to be a big number depending on the condo. And even though, so you're making a conscious decision at that point, maybe there's no way you're making enough to where it's a 20% margin on your gross, but you're saying, you know what, I still want to get in the game. It's worth it to me to give up on the entertainment side of the miscellaneous category, pull some of that 30% into the 20% category, because maybe you need to bump it to 27% or 28% on the home budget to afford that condo, right? So I was trying to illustrate the concept. There's a little bit of some leeway there with that category. Yeah, and please, if you're whoever's asking that question, reach out to us. Let's do a financial plan for you. We can figure out your percentages and we can dig deeper into that.
Is now a good time to refinance? And then in parentheses it says fixed or variable ?
So I think again the catch-all answer to start with is it really depends on your personal plan, and it's not too cliche to say that. It really matters. Now, with that being said, overarching themes here, we are in an incredibly low interest rate environment. I think a lot of people would be able to refi intelligently right now and have a much lower rate, either bring down the payment itself, or again, even if you keep the same payment you used to have, but refi at a lower rate, you're speeding up the amortization schedule on that loan. So there's some arbitrage to be had there too. So absolutely, I think it can make a lot of sense to refi. And then again, I think most times fixed rate, when you're this low on the scale of interest rates, fixed rate makes a lot of sense to me right now for most plans that I see.
Beautiful. Okay, so the answer I think is going to be, it depends on your situation here as well.
Mhm.
But when should I take Social Security? So I think we're moving from young accumulator to getting closer to retirement. Social Security.
Yeah. So I'll give a general rule of thumb here. So I'm going to paint an extreme scenario where one person has 100% of their money saved in retirement accounts. So these are pre-tax accounts. They have not been taxed yet. And on the other side of the scale, you have someone who has 100% of their money in after-tax, just cash and taxable brokerage accounts, right? So you have opposite ends of the spectrum here. In general, someone who has all the retirement side of that, they're going to want to actually probably take it a little bit earlier. Again, there's a lot of nuances here, but most times it makes sense to take it earlier because they're taking advantage of all the tax-deferred money that's going to continue to compound, and it usually works out better in a plan. The opposite extreme, if you have all of your money's already been taxed, then maybe waiting and using the Social Security aspect as a deferred interest kind of it's the same thing. It's tax deferred interest essentially that's accumulating into the form of a bigger Social Security payment. And you can kind of wait that out if you're on the non-qualified side of the fence. And again, it really does depend on your situation. I hardly ever see someone who has one or all the other. It's usually a mix of that too. And then it's a break-even calculation that we can run for you.
Yeah, I mean, I think a lot of it comes down to, we can tell you mathematically what might be the right choice, but, that doesn't necessarily even mean that mathematically, because it's the right choice, that it's the right situation. A lot of it comes down to how long are you going to live, right? We don't really know that answer, but even if we knew how long we were going to live, that still might not even be the right answer. And I'll give you a real life example why. Okay, my mom is a fantastic example because for her, she says, hey, as I age, I don't need more money. I know myself, I'm probably going to need less. I'm not going to be going out. I'm not going to be spending as much. I'm not going to be traveling as much. I like to be home and I like to cook at home. And this is a real life conversation I've had with my mom. My mom chose to take the Social Security as soon as possible because she knew that she would be spending more now. And she said, just give it to me now while I'm still out and about running around doing everything. And then even though I'm giving up a higher benefit later, I have no intentions of being as active later. I'm pretty sure I'm going to slow down just like my mom, who's 90 right now, has. So I think it really is very individual, and it depends on everybody and everyone's situation. We can, of course, always help you build a plan, look at the math, see mathematically what's best. But I think that lots of pieces like that are things worth taking into consideration.
So yeah, the qualitative mixed with quantitative. That's financial planning in a nutshell, right?
Yeah.
You're constantly balancing those two things.
Let's see. I think we have time for about one more question, if we have one more in here. Okay, here's one. I might actually jump on this one. So my friend told me that life insurance is a good place to accumulate cash for someone who is young. What are your thoughts? The reason I say I might want to jump on this one is because I came from a background where I was in insurance for almost a decade. And I understand life insurance, the cash accumulation features that are available inside life insurance. And this can be highly individualized. It can be very expensive because you're paying for the cost of insurance inside of the policy. So this is really most beneficial to a very slim group of people that are out there. The young accumulator, no, I would not make this as the general recommendation of, oh, I'm young, I should, I can get some life insurance and accumulate cash at the same time. For somebody that's young, you're better off buying an inexpensive term policy. And then if you have extra money left over after paying for that, then invest that difference in a brokerage account or a retirement account. Now, where this can come into play for somebody and possibly sometimes be a good benefit is somebody that is maxing out their existing retirement accounts now. Maybe they're phased out of making contributions into something like a Roth IRA because their income levels are very, very high and they can't contribute to a Roth program anymore. They have excess money that's left over. Then you could start to kind of have this conversation about where that might make sense. But again, the big assumption that you're really making here is it's a play between the cost of taxes over time versus the growth. I'm sorry, not the growth, versus the cost of insurance inside of the life insurance policy. So if I'm invested in a brokerage account and I'm paying capital gains, or if I'm putting my money into this insurance policy and I'm paying insurance fees underneath, and then there's growth that's happening inside of the two accounts, which one ends up netting out higher in the long run, and it's debatable. That's the best answer I could give on something along those lines, because it can get even more complicated than that. There's lots of gotchas and things that exist inside of there. So you're best off when it comes to that, keep it simple. I think that is about it. I think that's all the time we have. So Chris, Megan, appreciate both of you taking your time to educate all of us today. All of our attendees, we thank you so much for taking the time out of your day to join us, and we want to wish you all a very happy holidays. And we look forward to seeing you soon. Again, stick around for the survey at the end. We would love to hear from you, especially if you would like to book a financial planning meeting or a review meeting before the end of the year. Thank you so much.
Thank you, everybody.